Welcome back. Now we're going to have a difficult subject matter, how to deal with capital structure when there are taxes. So the first thought experiment that should help you is to think of yourself as someone who holds both the full debt and the full equity. So there's no argument between the two. There's no problems between the two. It makes understanding the concepts easier. And it's kosher. Everything that we do is kosher as long as you can issue the debt at the fair price. So this is perhaps near perfect capital markets, except for this one thing, which is corporate income taxes. And we're going to assume you are a zero personal income tax entity. So for example, you may be a charity or an endowment that is not taxed, or a state or something else. You worry only about the corporate income tax. So we're going to work with the simplest possible example as usual. We're going to have a project that has an investment cost of $200. It's going to get operating income before tax of $80. There's going to be no debt in our first example, so there's also no interest. That means that all your income before tax is going to be $80. You have to pay corporate income taxes at 30%. Of course, the return next year, if your investment cost was $200, your operating income is $80, will be $280. So now, what is the corporate income pre-tax and post-tax? What will Uncle Sam get?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, pre-tax, we know it's $280. Post-tax, we have to subtract off the 30% off the $80 that you gain. That is going to be $24. So you will have $256. Now, that's going to be next year. You're interested in what it's worth this year. At 12% cost of capital, you will have $256 next year, and that's going to discount to $228.57. Remember, in this example, you are the holder of all debt and equity, and now we're going to assume that your firm issues bonds worth $139.16 today at an interest rate of 9%. So that means you are going to have to pay $12.52 in interest payments next year. So, what is the corporate income tax now? What will Uncle Sam get?
Please pause this video now, answer the question on a piece of paper, and then continue.
Same as before, we start with an investment cost of $200. Operating income is still $80. However, before we calculate the tax, we first subtract off the interest. The interest in this example is $12.52. So your income before tax is $67.48. Now you only pay $20.24 in taxes. How much will you get?
Please pause this video now, answer the question on a piece of paper, and then continue.
Go back to the previous table. So we have your corporate income post-tax, which with the same calculations is $47.23. But in addition, you are also going to get the $12.52 in tax-free interest. This comes to you. It is tax-free because we assume at the beginning that you were a tax-exempt institution. You as the institution owning the company never have to pay any tax on what the company pays you in interest. So it's the $47.23 plus the $12.52. What is the present value of your total take now?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, equity gets $47.23. Interest payout is $12.52. Capital return, of course, is still $200. So in total, you're going to have $259.75 next year. This discounts to $231.91. So now we're going to do some more calculation on this. In this new capital structure, what is this firm's debt to value ratio? And you can actually just look back and look it up. Look at the debt amount and look at the calculated firm value.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, I cooked up the example. So the debt amount is going to be $139.16. The total value of the firm is $231.92. So your debt to value ratio is 60%. What is the difference between corporate income taxes paid in the two different scenarios? One in which you were financed with all equity, and the other where you were financed with 60% debt.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, all equity, we said, you're going to have to pay $24. 60% debt, you only had to pay $20.24. Remember, you own the entire firm. The only money that leaks from your system is the money that you pay to Uncle Sam, which means that if you pay less in taxes, there's going to be more left to you. So what is the difference between your net receipts in the two scenarios?
Please pause this video now, answer the question on a piece of paper, and then continue.
$3.76. What is the present value of this difference?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, it's $3.76 next year. You discount that at 12%. The amount of money that the 60% debt ratio has saved you in terms of today's amount is $3.35. So compare that. 60% equity financed next year, $259.75, discounted $231.91. 100% equity financed, you only get to keep $256, discounted $228.57. The difference between the two is $3.35. Your capital structure choice created $3.35 of present value. And that's really the tax shelter that debt provides. And what we're going to do in the rest of these slides is we're going to talk about methods that basically get you to the $3.35 and that are used heavily in the real world. The first method is flow to equity. And you've really already done that, because all that means is that you just construct the pro forma with the individual components, one of them being you subtract out interest before you calculate the corporate income tax. Now, you will need to estimate the appropriate cost of capital for the firm and for the debt and for the equity when changing debt. But, that's a second order concern. The big deal is that when you subtract out interest, it immediately reduces your tax obligation. The method is a little bit misnamed. If I were to name it, I would just call this the pro forma method. But in the real world, this is called the flow to equity method. Let's just talk about the value of the tax shelter itself. So we want to create a formula that uses the inputs that are available to us. What are those? Tau, the tax rate that the company faces, in our example, 30%. The appropriate expected rate of return on debt, which in our case is simply 9%. the appropriate cost of capital on the firm, which in our example is 12%, the amount of debt that we are choosing, which was something like 139, and the value of the firm, which was going to be something like $256 divided by 1.12 in order to make it a present value. So you have those values in here. Can you guess a formula that takes these inputs and gets you to $3.35?
Please pause this video now, answer the question on a piece of paper, and then continue.
So take the first bullet point here. This component here is going to be the amount of interest that you're going to have to pay. The amount of interest that you're going to have to pay that you can subtract off in your income statement before you calculate tax. Your tax rate in this example is 30%. That gets you a number of $3.75. That is the future value. This is what it's going to save us in the future. In order to make it what it's worth today, I still have to discount that from next year back to this year. And for that, in this particular example, I'm going to use, as we did before, the discount rate on the entire firm, which in this example is $3.35. Again, this is simply the flow to equity method. It works out the pro forma, reads out the tax payments, figures out the residual owner cash. This is the money that our debt-laden capital structure has saved us. Now, what if I start with the as if 100% equity financed and fully taxed cash flows of $228.57 today, and contemplated a leverage restructuring. The leverage restructuring means I'm going to go to a 60-40 debt equity ratio. Then what formula would I use to compute the value to get to the present value of the firm with a new capital structure?
Please pause this video now, answer the question on a piece of paper, and then continue.
So what this version does is it takes the expected cash flow and discounts it by the firm cost of capital as if it was completely equity financed. That is this part here. Oh, and it's also here. So that was $228.57. This was the 100% equity financed capital structure. But we know if we go to the 60-40 debt equity capital structure, we're going to get extra money from Uncle Sam Bank. The amount of extra money is going to be how much I pay in interest, which is this part, multiplied by the tax rate, which is going to be related to the saving, properly discounted also to today. And that we have already calculated as $3.35. So the answer is $231.93. The tax shelter of debt was $335, and we could add that back to the firm as if 100% equity financed without any tax shelter whatsoever. In APV, what exactly is the first term cash flow that is then adjusted up? Is it whatever the current capital structure of the firm is? So if the firm had, say, 50% debt equity ratio today, is that what would go into the APV formula?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, it is always the as if fully taxed capital structure that is the one that has absolutely no debt. So in our example, this is the $256 that then has to be discounted. Now, this is a super nerd note. You really don't need to know this. I've assumed a tax shield, cost of capital, the same as the rate of return on the firm. That turns out to be actually not perfectly correct, but this mistake is a second order mistake. If you're really intellectually curious, you can read it up. Otherwise, just ignore it and take my word for it that it doesn't matter much. Now, this was adjusted present value, APV. It's basically the same as flow to equity, which I would really call the pro forma method. There is another method that is in even wider use out there in the real world, and that's the weighted average cost of capital, WACC. It starts again, like APV, with a fully taxed, 100% equity financed, no tax shelter value of the firm, which is $256 next year. And what the WACC method does, it instead reduces the effective cost of capital. And I'm going to show you that in some simple cases, WACC and APV can give you exactly the same answers. Now, usually I would have just said, well, in this case, let's just forget about WACC. We're just going to live with APV. Why do I need to bother showing you another method? The reason why I'm doing this is because it is in such wide use out there in the real world. There's a second reason for it. It turns out if a firm thinks about always having a constant ratio of debt over equity over time, then WACC turns out to be more convenient, whereas APV tends to be more convenient for a firm with a constant amount, dollar amount of debt over time. So get ready for a ride. This is going to be a show. And I will not expect anybody to be able to derive this, but I want you to be able to look at this and convince yourself that what we are really doing is very similar. So again, we start with the APV. We have the value of the firm as if 100% equity financed, which is here, plus the tax shelter, which is this formula. And it gave us $231.92. So what's the first step that we're going to do? Well, if you look at this, I'm going to move the 1 plus 12% over to the other side. Now the formula looks like this. And of course, since we've just multiplied both sides by 1.12, it still holds. It's still an equality. Okay, so what do we have here? We have next year's interest amount, next year's cash flow. That's going to be worth what the present value is today, multiplied by 1 plus the rate of return on the firm. Okay, what's the next step that we can do? Well, what we can do, going back here, is we're going to move the part that was here, and we're going to move that over to the other side. So that's going to be this formula. The next thing that I'm going to do is I'm going to divide the left side by the present value and multiply by it, so nothing happens. So I'm going to divide this by the present value. I'm going to divide this by the present value, and I'm going to multiply it by the present value. So that's all that I'm going to do. Go to the next slide. That's exactly it. Well, except I've moved the debt divided by present value here, and the present value is on the right side instead of the left side. Now, debt divided by present value, that's really the debt ratio of the firm. That's this number here. Okay. The other numbers we already know. This one was 12%. We have the tax rate of 30%. We have the expected rate of return on debt of 9%, and we have the expected cash flow of 256. All of those numbers are, of course, here as well. So the next step that I'm going to do is truly trivial. I'm just going to replace the 139 divided by 232 with the actual value, which is 60%. So that's the formula here. That basically just substitutes this number in here. It's the weight of the debt in the capital structure. That is the formula version of where we are at the moment. We're almost done. So we have the present value on the left side. we have the expected cash flow on the right side, and then we have this long expression here that is basically sort of like a cost of capital. We're going to move that over to the other side, which is what I've done here. That says the present value is my expected cash flow next year, discounted by a rate that is the rate of return on the firm, the opportunity cost of capital, but subtracting out the tax shield in a particular way. We're going to do 30% times 9% times 60%. So what we have done is we have tax adjusted the weighted average cost of capital. We'll just rewrite this a little bit more, and it's going to be very little rewriting. So I have an expected rate of return on the firm here. That is going to have to come out to 12%. So what I'm going to do is I'm going to rewrite this here, which is the expected cost of capital on the firm minus the tax shelter. And I'm going to just expand this part here into a part that is this and a part that is that. Well, this is actually the one here. Then I have another aspect, which is this part here, which is going to be this part here. And you can see the formula is still the same. I haven't made an arithmetic error. It's still 10.38%. This turns out to be the weighted average cost of capital formula. So the weighted average cost of capital is the weighted average cost on the equity plus the weighted cost of capital on the debt, tax adjusted. And the present value then is the expected cash flows discounted by this debt tax adjusted new cost of capital. This formula is in very wide use. In fact, when people talk about WACC, which they do all the time, they mean this. They do not mean the formula that we had earlier, where we just took the weighted cost of capital on debt and equity. Now, if the corporate tax rate is 0, then our new weighted average cost of capital formula collapses to the same WACC formula that we had in the perfect capital market without any taxes. The non-tax adjusted weighted average cost of capital is not in practical use because times when you really want to use it, you typically do have a positive tax rate. Every CFO is familiar with and uses this WACC formula with the tax adjustment. And maybe half of them even do so correctly, because remember, it always has to be applied to the present value as if the firm was fully equity financed and had no tax shelter whatsoever. So here are the methods that we can think about. In a perfect capital market, we had no taxes. So this isn't really comparable because it's different from the other situations here. Now, what we really did under the flow to equity method, we just worked through the individual lines and we got at the result this. What we did with the imperfect capital markets with WACC is we took the $256, we discounted it by the lower cost of capital, the WACC appropriately adjusted for the tax obligations that are reduced by the debt, and we got this formula here. And then we had the APV formula as well, which again started with 256, but instead of using the lower cost of capital, it kept the 12% higher cost of capital, but added back the tax shelter due to debt. And it got you the same number. All three methods have the same goal. They all want to adjust the value of the owners that comes from the fact that debt actually serves as a tax shield, because you can first deduct the interest before you calculate the tax. They all serve their purpose, they all can be useful, and in many cases they are the same, especially when you can easily translate them. Personally, I prefer flow to equity, then APV, then WACC. for long-lived firms where, second order mistakes that have to do with the cost of capital and how the debt path changes over time, you can get slightly different numbers, but don't overread this. This is really not that important in this detail. Mostly all methods are okay, but what you must never do is double count. So you should never apply a tax-adjusted weighted average cost of capital to the cash flows that already had the tax subsidy calculated in. So 259.75 already contained the tax benefit. So don't discount it by 10.38%. Or don't add the tax shelter to something on which you have used the WACC. Tax adjustments like this can only be used on the full $256. Here is a real neato formula. It's a quick tax saving formula. Let's presume you have a firm. It levers up by $1 billion for 1 year. So it takes on debt for $1 billion, pays it out to shareholders in dividends or something like that, something that is not taxed. Well, it's not taxed because this particular owner is not taxed. So if the firm levers up by $1 billion for 1 year, roughly, how much will you be saving in corporate income tax?
Please pause this video now, answer the question on a piece of paper, and then continue.
There's an interesting formula here. Start with this. This here is the dollar interest on the debt. D, capital D, is the debt amount. R is the interest rate. So this is the interest payment that you're going to make. Tau, remember that from the APV formula, is your corporate tax rate, which in this example was 30%. And of course, because this is going to happen next year, we have to discount it by the cost of capital, which I'm just going to call 1 plus R here. This is if the firm levers up by $1 billion for 1 year. What if the firm levers up by $1 billion forever? Roughly, how much will you be saving in corporate income tax in present value today?
Please pause this video now, answer the question on a piece of paper, and then continue.
So remember, when we had one period, we had C divided by 1 plus R. When we had a perpetuity, we used C divided by R. What we have here now is we divide by R instead of 1 plus R. Now, this becomes interesting because I have an R at the top, I have an R at the bottom, and those roughly cancel out. So, order of magnitude, we are calling the tax shield that you're getting, the present value of the tax shield that you're getting, tau times capital D. This is an upper bound. So forever is an overstatement. I'm screwing up a little bit on the cost of capital, whether I use RD or RF, but it's roughly okay if you sit in an executive meeting and you're thinking about, well, if I'm going to lever up by $1 billion, roughly how much should the value of my firm increase right now, this moment? So, for example, if you're in the 30% tax bracket and you're taking on $1 billion of debt, the value of your firm should go up by about $300 million. No calculators necessary. So I could just, in my head, roughly get this. Now, I should also remember that this is an overstatement. So really, somewhere between $200 and $250 million. Again, taking on $1 billion in debt extra forever gets me about $200 to $250 million in value created for my shareholders immediately. Now, think about this for a moment. I didn't have to go out and look for new great projects. Didn't need to do this. All that I needed to do was, I'm going to call this part debt and this part equity. And magically, I've just taken money from Uncle Sam. Well, I no longer have to give that much money to Uncle Sam. It's amazing. Just a little bit of finance creates a huge amount of value. And leveraged buyouts, actually, one part of the reason why they've been so successful is because they save a lot of money on taxes. Now, if you think about this, what you really want to do is you want to call every payout that your firm makes, whether it's really truly dividends or interest, you always want to call it interest. To the recipient, it doesn't matter what it's called because they are tax-free. To you, it matters as a firm, it matters quite a lot because if you can call it interest, you no longer need to pay tax on the money that you otherwise would have to pay tax on. So why don't firms lever up to the wazoo?
Please pause this video now, answer the question on a piece of paper, and then continue.
Choice 1. They're too dumb. Unlikely. There's very few firms that are that dumb. 2. The cost of capital inputs in the formula increases when they do this due to other reasons. So, for example, if the firm really takes on a lot of leverage, maybe it goes bankrupt a lot more often, and then the lawyer vultures come in and they need to be paid. We're going to talk about those in a later lecture. So, that's a good reason perhaps you want to limit the amount of debt that you want. Choice number 3. They don't want to because managers don't want to. You know what? If you have a lot of debt and you're a manager, you better work your butt off. Because if you don't work your butt off and you can't pay the interest and principal that is due, you're going to be forced into Chapter 11 and probably be fired. Virtually all managers get removed in a bankruptcy. So, you want to have a comfortable life? You don't want debt. Another reason is they're currently under the looking glass. So the IRS is looking at them and is wondering, what are you doing here? Are you trying to sneak around with too much debt perhaps? Is what you are calling debt really more like equity? It's quite possible. And many firms already have a lot of leverage already, and especially a lot of off-balance sheet leverage already, so that's more than what we usually see when we just look at the public data. Nevertheless, many non-financial firms are probably too conservative. They could probably be more innovative. If they really need protection against bankruptcy, they can get lines of credit as insurance, but they could probably create more value if they had more debt. That is in the interest of the owners of the firms. It is not necessarily in the interest of the managers of the firm. Now I'm going to switch subject one more time. In a perfect capital market, in one of our first lessons, I explained to you that you can make investment and financing decisions separate. That is, it doesn't matter when you want to eat ice cream. You always take all positive net present value projects. You use the capital markets to shift capital to wherever you want to consume. So, you could make investment, financing, consumption decisions all separate. It did not matter when you needed money. Take all positive net present value. What about now? Are investment and financing decisions still separate in a world with corporate taxes? That is, can you first consider the projects and then worry about financing later?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, the answer is now negative. So the tax shelter is now an integral part of the value of the project. And there are projects that allow for more tax shields, more debt, more interest payments than others. For example, research is very hard to collateralize. It's very hard to go to a bank and say, you know, I've got this great research here. Why don't you lend me another $100 million? On the other hand, if you have a building, buildings are very easy to collateralize and take a mortgage against. So under those circumstances, that tax shield is a big part of the value of the building. Once perfect capital markets disappear, it is no longer true that all that matters is the net present value of the project without considering the financing. Now the financing becomes part of the value of the project. There is other corporate tax shelters that we're not going to talk about. There are leasing arrangements, transfer pricing arrangement, operating losses carry forward, many other things. Debt is just one of those. Transfer pricing is particularly valuable across countries. So, what you can do, for example, is ship a product from Singapore over to the United States. Singapore has a very low tax rate. So if the profits show up in Singapore, the company is taxed very little. How do you make profits be higher in Singapore and lower in the US? Your subsidiary is going to sell all its products over to the United States at inflated prices. That means the US operation isn't going to make as much profit, and the Singaporean operation is going to make a lot of profit. For that reason, most of the assets of many large firms, especially tech firms, are actually in other countries. Ireland is a low tax country. All of the patents of Google and Dell and other firms are held in places like Ireland and Singapore, and their US operations are leasing them. That's not because they were developed in Ireland or Singapore. That is because as soon as something was developed at the lowest cost possible, it was sold to Ireland, and now the US operation is leasing back the intellectual property from Ireland and pays a lot of money to it, so the profits show up in Ireland rather than in the United States. Debt tax sheltering works too, but it's not as effective. That's it for this video for the APV and WACC tax adjustment formulas, very widely used in the real world. There's still one problem that we haven't discussed yet. That problem is we've assumed that the owner of this firm was like an endowment without any tax liabilities, tax obligations, zero income tax. But that's not really true in the real world because there's also many taxable investors. So if investors get taxed when receiving dividends and interest, how does this matter? Well, it actually does. And this will be the subject of the next video. See you soon. Bis bald.
The best way to teach your kids about taxes is by eating 45% of their ice cream.
How do you know taxes work just like transaction costs?
How?
If you earn anything, it's minus taxes, and if you buy anything, it's plus taxes.
Not bad. It's hard to believe that America was founded to avoid high taxation.
Like bad professors, and I know at least one, taxes are often misunderstood, but rarely forgotten.